Oh, guys, there's a massive opportunity out here in the marketplace at the moment. When you're selling your unit to buy your townhouse or house, there's a secret opportunity that's just opened up. It's called the House Gap Arbitrage. We're going to talk about it right now. Stay tuned.
I'm the ringleader, so listen up.
Josh Wabshot, look at us using such big words.
I know. Us real estate agents, eh? Who would have thought?
I knew when I was going to get older, I was going to use big words like arbitrage.
Well, your English teacher hopes so.
Okay,
But yeah,
now this is big opportunity, Mr. Wapshot, the economist. And you brought this up yesterday and I loved it. Can we talk about what this went on in our sales meeting when we were all talking about it, sort of round circle. There's this unique opportunity in the property market now, which is very exciting, which is saving a huge amount of interest and money for people. First of all, can you explain the word arbitrage?
alrighty. So technically, arbitrage is a financial term that means taking advantage of a price difference for the same or similar asset across different markets. So that's the official definition. And so basically, what layman's terms, you're essentially investing in an asset, maybe in something that's in a downturn or a correction, whether it be precious metals, property, stocks, pretty much goes across all asset classes. And essentially what you're doing is riding on or putting your money on the line that this asset appreciates from that point. And obviously that is your profit. So moving across from different markets, you're moving from, say, a trough phase, which is considered part of a downturn, moving into that uplift phase. That's the arbitrage there, where you're taking pretty much a gamble on the asset improving in the near future or long term. So in house terms, that would be buying something in, like, say, COVID, or in a downturn or high interest rate environment, or with wars going around amongst the world, buying in that environment with the idea that things will improve, things will get better, and therefore so for the market will. And then obviously the value of that asset when you go to either sell it for a profit, or you might go to refinance to fund another purchase.
That's the complex version. I like it. I like it. I like the word arbitrage. Now, the real weird concept, and this is where it plays with people's heads. If I was to say to you, you're going to take on a 30-year mortgage to go from a unit to a house, and the mortgage is going to be $1 million. You'd say, shit. If I said to you, if you do it in the right market, you can sell the same unit and buy the same house, potentially in a bad property market, and the changeover is only going to cost you $500,000. So it's counterintuitive, because when you sell like a champion, you get more money. You then have to buy like a champion and pay a lot more money on your house. So your mortgage is $1 million. Your changeover for the same asset is $1 million. Your 30-year mortgage is $1 million. Now, if you do that in a bad property market, or not a seller's property market, but a buyer's property market, hardcore, or there's adversity going on, you can be an opportunist, sell the same unit, you're going to get hurt and sell it for a little bit less. You're going to buy a house, the seller there is going to get a bit hurt, and they're going to sell for a lot less, but your mortgage is only $500,000 for doing the same transaction. And that's the mortgage you take on for 30 years. Arbitrage.
Exactly right. And then another way of thinking of it as well is if you do have, generally you do see houses take a bigger hit during a correction phase. But say, for example, we had a
Yeah.
correction of, just to make it easy, of 10%. So you've got your 1 or 2 bedroom apartment at, let's say, $1 million. And to make it easy, let's say you've got that house there of $2 million that you're wanting to move into. That 10% difference, the loss on your unit, 100 grand. But the advantage, you're actually $100,000 ahead, because that correction on the house at 2 million is 200,000. So when Mark's talking about that changeover, that's the difference there, because you're actually 100 grand ahead. You're borrowing $100,000 less. So I think it's a really something people don't think of.
What if I said to you right now, in this market today, the unit sector is performing better than the housing sector? So that example you gave, you're saying units could take could have taken a 10% hit. Houses could have taken 10% hit. What if I suggest that houses made a 15 or 20% hit and the units took a 10% hit? Not only are you up that 100 you've suggested, you're even more,
Additional. Yeah, exactly
because
right.
20% is 400K on a house. So in trying times, it when you're changing, when you're going into a higher value asset, your mortgage that you take on, your changeover, your mortgage that you take on for 30 years is going to be lower. It doesn't make sense, because you think to yourself, my unit's worth so much, the market's pumping, and then the houses are pumping, and then you're in a pumping market, and it's like mortgage 30 years more. But then when it's stressful, shit market, mortgage take on for 30 years, same asset, less.
And these are generally, Mark, the people that do well out of these scenarios. A lot of people sort of sitting on their hands. I won't make the move. I'll wait till this is over. The people that are making these moves, taking the risks, obviously, are the ones that are succeeding in these markets. I mean, I say this how many times on this podcast? You can't just take a small fraction of time to give yourself an idea of what the future might uphold. You're going to take the last 100 years as an example, and when we take that large amount of data over those 100 years, every 10 years we've seen it, property in the Northern Beaches has doubled. So I really find that people short-sighted on the fact that, oh my God, on the news every time I come home is another this, another that, or fuels at $3. But it really is the people that are making the decisions, finding these opportunities in the market, that tend to do really well. Because how often do you have a war in Iran? Obviously there's always been tension there, but in terms of other countries dropping bombs on other countries, it's not a daily thing. So although it's bad, and obviously you don't want to see people, in these positions, but these opportunities only come around once so often, and you try to find the good, try to find the light in a bad situation. I find these changeovers are one of those examples, Mark.
And Josh, I got so many stories. Not even real estate stories. I got so many stories where people, they did that in the time when everyone was zigging, they zagged, whether that was, I don't know, business opportunity, a stock, I don't know. And you go, how smart were they? How smart were they? You know what I mean? And then, 'cause I knew that was a good buy, and they did it.
Yeah.
Do you know what I mean? And you saw it, and you saw it play out, and then you came back 5 or 10 years later. Yep, I saw that. So again, supporting what we're saying in this arbitrage, if you just tuned in on houses, there are people, and I'm not suggesting it's going to be a terrible property market, or it's a bad property market or anything. I'm just saying that there are certain real estate markets, ebbs and flows, when it's very counterintuitive, and it actually happens the opposite. So in trying tough times, there's really good opportunity.
Definitely. And you find that, Mark, you would know from, obviously, having one of the biggest rent rolls in Northern Beaches, you meet a lot of landlords and you get to see what they do over their time of investing. And you'd probably say some of the most successful landlords that Novak deals with are generally buyers that look for these opportunities that we're speaking of this morning, and how they're able to scale such a portfolio over their time.
I see it, and it's still hard to do. I think before we came on air, we were talking about diets this morning, about just drinking a bit more water during the day. There's basic stuff that you see, and it's still hard to do, and it's the right thing to do. So circling back to those landlords, and what they're doing, and what you got to do yourself. It's hard. And what we're suggesting about that house gap arbitrage, you hear it, you see, you think that's a great idea, but it's so hard to do.
It is. But, from the examples that I've seen, generally most of them turn out quite positive for those people that took on the risk. And I think there's no better risk than you can take than property in Australia. So see how it all pans out over the next couple of weeks, hey?
The house gap arbitrage, we've just explained it. We've given it 3 words as a label. Even we didn't know what the words would be, but I'm pretty proud of coming up with that, because we're going to use this house gap arbitrage a lot in our business. Hope you enjoyed today, and I hope this helped you out.
Thanks, guys.
Thanks, Josh. Cheers, mate.